Today we are looking at a technology stock with a $2.5 billion market cap, a price to earnings of about 20, earnings per share annual growth of about 8%, and a debt to equity of just 0.7. Pretty solid overall. Looking at December 2015, this technology stock, things look all right so far. Price to earnings seems reasonable at this time. Earnings per share growth is solid at 8%. It's not unreal, but it's decent enough. I like their debt position. Gross margin of 34%. So that's okay, especially considering it's a technology. Now, we don't know if this is a software business or a hardware company or what kind of technology they are manufacturing, but a gross margin for a company, at least in this industry, of 34% isn't great. Usually you want to see around that 50 to even 70% range here, but it's still okay. It's not bad. You're seeing an operating margin of 7% and a net profit margin of 4%. So this is it's good that it's profitable, but it's not unreal. It's something that you would definitely want to see a bit more of a wider berth. And we will find out at the end what stock this is, but something to consider there. Return on equity at 9% is okay. It's decent. Again, the 10% threshold and above is the goal, but 9% isn't too terrible. Revenue growth of 1%, okay. Net profit growth of 3%, okay. Shareholder equity of 5%, okay. Free cash flow of 2% and a debt to free cash flow of 5%. So while their debt to equity is only 0.7, their debt to free cash flow, it essentially means that it would take 5 years to pay off their free cash flow. It's not great. I don't necessarily like seeing it. I like it less than 3 usually is kind of how I look at it. And now you're looking at a stock that over time has appreciated from, in 2010, a price per share of $54 up to $98 per share. So things are looking pretty good from that standpoint. Now, the only question and one thing I'm concerned is, why are these growth rates so low when it's appreciated that much in price? I don't really like that too much. I'm a little skeptical there. Let's look at the financial reports and then we can make a determination as to whether to buy, pass, or short this stock. So what we're looking at as in 2013, we're seeing revenue of about $3.7 billion. This has actually shrunk to $3.3 billion as of 2015, so not a great sign there. Their cost of revenue has actually decreased a little bit, so that's okay. But we are seeing that their operating income has declined as well. So they had $271 million in 2013. This has fallen to $236 million as of 2015. So not a great sign overall. And then looking at their net income, it's virtually flat, but there has been a drop of $153 million down to $126 million. So not necessarily a great sign that operating income and net income, as well as revenue, have all dropped. So in a 3-year span, things are not really improving for this business, which isn't great. Looking at their cash, well, their cash pile has also fallen and taken quite a hit. So we're seeing $64 million in 2014 down to just $35 million in the recent years. Again, it's a profitable business, so that's not overly concerning. But let's say because of their tight profit margins that there's an economic contraction, maybe we face a recession, things get worse. Well, those tight margins, that might flip to a negative. And then that starts to be a real concern where now you're really starting to question it and be like, uh-oh, our cash pile is depleting and we're losing money annually. That means that the business is going to need to raise more capital and we should be a little bit concerned. Now, we can see the last story here that from an cash from operating standpoint, that once again, there is some confidence, at least, that they are retaining a certain amount. But from 2013, we're seeing $249 million. This has dropped to $223 million as of 2015. So once again, not ideal that we're seeing this position where they're actually starting to grow less, contract in recent years. I would be a little concerned, especially with all the price appreciation that they've seen. And last part is just to see in their balance sheet, are they seeing a difference in their debt? So they've actually paid off a little bit of debt, about $200 million from 2014 to 2015. So that's improved. But all things considered, we're seeing a business that is contracting when it comes to operating income, revenue, net profit, and operating cash flow. Not a positive sign, something that we should be a little concerned with. And now it's time to make our decision as to invest or not. So analyzing everything at a high level here, Once again, we're looking at a $2.5 billion technology company with a PE of 20, earnings per share annual growth of 8%. They have a tight net profit and operating margin. Their gross margin's okay. And on a 5-year basis, you're seeing a little bit of growth. But when we look at the 3-year scope, they are contracting in all these key areas. And their debt to free cash flow isn't that great. They do operate with about $1 billion of debt. So something to be a little worried about. And then lastly, we're seeing some price appreciation that I believe doesn't necessarily justify the present state of the business. And so all things considered, looking at this technology company, I'm going to take a pass on this investment and let's see how I do. So the stock has actually appreciated quite a lot. It grew 495% from that time. Again, it's okay to miss on an investment where you're not making unnecessary risks and losing money. Warren Buffett always said there's 2 rules to investing. Rule 1 is don't lose money, and rule 2 is follow rule 1. So in this case, I didn't necessarily like what I saw. Things looked a little risky. It wasn't overly concerning. The company was still profitable and operating, but everything was contracting. And so I decided to take a pass. At the end of the day, passing on a stock just means that you miss out on the price appreciation, but you also miss out on the losses and you live to see another day. And in this case, I did. But at this point, Khaki International on this day announced a $550 million deal to acquire L3 National Security Solutions, a provider of intelligence, defense, and federal IT services. From that point, the stock grew 495%, an 18% annual growth rate from 2015. We passed, we move on, so be it. Let me know what you think of my analysis in the comment. And if you want to play Compoundle, you can go play it for free at compoundle.com. Check it out and put your stock picking skills to the test.